JJ the CPA here. Hope you're doing well. So let's talk here. This comes out of my employee retention tax credit. In case I make this one public, you'll find in the body of this a link to it. Get instant access to this entire seminar and all of this information and links and whatnot. But what I want to focus in on is the gross receipts test. And here I have available amongst all these Excel spreadsheets that I broke out separately for you. I have the gross receipts test that we're going to look at for 2020 versus 2021. And we do know that for 2020, it's a 50% decrease that is required quarter to quarter from 2020 to 2019. And then in 2021, though, it's only a 20% reduction in gross receipts that's required. But you are seeing this right, okay? When you're determining your reduction in gross receipts for 2021, you are comparing it to 2019. So let's start with 2020, and really it's a matter of knowing what your gross receipts are. Of course, if you knew it quarter to quarter, you'd be ahead of the curve. This Excel spreadsheet, of course, comes with the seminar, but once you enable it, the numbers and the formulas are yours. As you know, if you've dealt with Excel, it's easy to override it. So be sure that you're checking your math, as I would say. So for year 2020, okay, that's what we're going to talk about. You compare it to 2019. So the way I've got it set up is that you can just put your monthly amount of gross receipts for 19 and 20, and then coming down here, pretty fairly straightforward analysis. But nonetheless, it's always nice to have an example and or just a quick spreadsheet to not have to reinvent the wheel. So we can see that when we take the numbers up here and add it up for the quarter, and then you start comparing, then this tells you what the reduction was. And in this example, this person then would, of course, qualify in quarter 2 and quarter 3 and would continue to qualify in quarter 4 of 2020 because the amount of reduction in quarter 3 was more than 50%. So in 2020, then they qualify automatically for the next quarter. And it doesn't matter. I mean, this person didn't get above even the 80%, but that's one of the big differences with 2020 versus 2021 is that when you have a quarter that's down, then the next quarter is going to automatically qualify. Now, with 2020, it is, of course, that 50% as I was telling you about, and we have this circumstance here where they are down 21.91%. So again, hear me on this. In 2020, they qualify for these last 3 quarters. Now, when we go over to 2021, okay, it is a 20%, but we're still comparing to 2019. So these are the same amounts. I mean, just as an example here, but we're comparing 19 to 21. You're hearing that correctly. You don't compare 21 to 20. This works to your advantage because 19 is before the pandemic. So most businesses probably were up. Hopefully they have rebounded by 2021. But nonetheless, it's the same exercise. You're taking quarter by quarter and then determining whether or not you're down. Now, let's take a look here because in this circumstance, when we're looking at quarter 1 of 2021, right? So you have to be down at least 20% compared to 2019. But we would look at this and at first glance go, oh, well, they're not going to qualify for first quarter 2021. However, there's a special rule, and it may further extend into second or third or fourth quarter. The IRS indicated they'll give us more guidance on that. But what we do know is that for first quarter 2021, there are 2 ways to calculate whether or not the business qualifies for quarter 1 of 2021. So They don't qualify when comparing 2019 to 21 first quarter. But when we go here in quarter 4, here's the special rule. If in quarter 4, the business is down at least 20% in quarter 4 2020 versus quarter 4 of 2019, and it's down at least 20%, it qualifies then for quarter 1 of 2021. What you have to remember is that these are completely two separate calculations. You have to look at it as the way that it was written, which is here's the rules in the law for 2020. They don't mix over in any way, shape, or form. So qualifying in fourth quarter of 2020, okay, has nothing to do with qualifying for 2021 under the old rules, okay? Under the old rules. And why is this important? Why is this important? Someone may not qualify under the old rules for fourth quarter 2020. They might have rebounded enough that in 2020, fourth quarter, they don't qualify for the ERTC. But if they are down at least 20%, when we now go into the rules and we're looking at 2021, if they're down at least 20% in fourth quarter of 2020, then they qualify for first quarter 2021. So there's two ways to qualify for the employee retention tax credit when you come to the gross receipts test for first quarter 2021. So let's just assume that there was no employee retention tax credit in 2020. It didn't exist. It never came about. Just pretend that for a minute. Now we're only looking at 2021. You didn't know about any other rules. You can't take it in 2020 because I'm pretending to tell you that it didn't exist in 2020. And the first time we're now dealing with it for 2021 in this pretend example, maybe we'll wash this away for you. So if the first time we were able to take advantage of the employee retention tax credit, this rule might read easier for you, which is this. The gross receipts test for quarter 1 of 2021 is two ways to qualify. If you're down at least 20% for first quarter 2021 compared to first quarter 2019, then you qualify for first quarter. If not, then the second test to determine if you qualify for first quarter 2021 is you get to compare fourth quarter 2020 to fourth quarter 2019. And if that calculation is that gross receipts are down at least 20%, then that qualifies the business for first quarter 2021. So there's two ways to calculate that. Today is the 21st of March. And the only reason I mention that is that the IRS is going to provide more guidance on how does this work for quarter 2, quarter 3, quarter 4, as in, is there two ways to qualify for second, third, or fourth quarter 2021? As it stands now, just because a business qualified first quarter 2021 does not qualify them for second quarter 2021. Okay? In 2021, as we see it now, it's standalone quarters. First quarter, you got two ways to figure out if you qualify. I'm just chuckling because it's like, what? So first quarter 2021, yes, there are two ways to determine if you qualify. But remember, in this pretend world for a second, I'm telling you, forget 2020 rules. Forget that you even knew about 2020. Don't think about 2020 rules. So in 2021, as we know it right now, March 21st, for second quarter, you need to be down 20%. The fact that the business qualified in first quarter has nothing to do with second quarter. Second quarter just needs to be down at least 20%. Second quarter 2021 compared to second quarter 2019. Okay? There's no comparison of 2021 to 2020 anywhere you look. Okay, and then as it stands now, third quarter 2021 would need to be down at least 20% compared to third quarter 2019. Fourth quarter 2021 would be compared to fourth quarter 2019. And for all of 2021, if you are down at least 20%, then you qualify for the entire quarter. And so this is in essence a calculation. You could obviously easily come up with your own, but this gives you an example to at least follow on how it breaks down. So that's how you do the gross receipts analysis. If I decide to make this video public, maybe even later, because right now it's available to those that took the seminar, and I cover this in the seminar. Both in part 1 and part 2. I go in more detail in part 2. But if you would like access to the seminar, go to the link in the body of this. You'll get instant access to everything in the first seminar and in the second seminar. So give me a second if you're interested and I'll let you know. But this seminar too is a little over 3 hours, and I go through it with this PowerPoint that you get access to follow along and make notes on. I also have 3 hours or so of Q&A that I go through. And then I've added a bunch of videos at the bottom, but I go through an economic or an executive summary, and you get a copy of this executive summary kind of talking about both of them. I give you some examples on how to calculate 2020, 2 different examples, and same for 21. I give you a flow chart, kind of how to walk through calculating and qualifying for 2020 versus 21. What's the economic value? And then here's all of these Excel spreadsheets. In Seminar 1, this was the only Excel spreadsheet. In Seminar 2, I added all of these Excel spreadsheets. We went through the gross receipts test, but I've got an Excel on how to calculate the average number of employees, which is fairly straightforward, but nonetheless giving you an example of that. Talking about the economic value, meaning if you're having to choose between PPP and ERTC, what is the analysis to make sure that you're, taking advantage of the most? And then also a big part is then once you know the time period and what year, you got to figure out, well, what wages and health insurance for ERTC purposes is considered wages. So I walk through a pretty detailed example, breaking out salary, hourly, part-time, and owners and things to that effect. And then when you get into going, okay, I do appear to have some overlap, well, then how do you figure out how to maximize both the PPP and the ERTC? And I go through these in the seminar in detail. You don't just get the Excel. I go through it with you, and then I have a mini video that goes along with all of this, and then just an Excel spreadsheet on calculating the credit. We know that there's 2020. I got 2 examples for both years, 2021. Then I walk through the most recent FAQs from the IRS, give you a breakdown summary. I go through how to prepare Form 7200. And I don't just give you commentary. I walk through it, pull the forms out, go through the instructions, and highlight for you what's related to the employee retention tax credit. Also, on the 941X, there's enough information that I go through in detail that I have a PowerPoint that you will follow along with that. Of course, I give you links to the 941, 941X, and then I go through an example of here's a Form 941, but if the tax credit had not been reported or reported properly, then I walk through with you, literally, as you can see, the numbers are in. I walk through with you one example with 2 results on how to go about that. And then I go through the 941 instructions. There are 23 pages, but I highlight and go through that with you during the video. Then you get everything in here. And then I've got these mini videos that go along. So I think at the end of the day, you're ending up with probably around 15 videos. So, and then in the first seminar, you just get everything. And if you click, you'll be able to see an example, but this is everything that you get: a deep dive into aggregation, the owners, how to report this, how it affects your taxes. And then as a bonus, I give you, it's not what this seminar covers, but related to the employers that get the sick and family leave tax credits. The self-employed also get those credits. The self-employed don't get the employee retention tax credit on themselves, but they do qualify for the sick leave. Probably the most value part of this is that what we used in or use in my practice, you can see I've got 4 tabs down here on how to go about calculating this credit as an employer. So if you have an employee with COVID, caring for COVID, or taking care of a child, or the other things that qualify. And then for the self-employed, same thing. Another Excel spreadsheet for you. There's 3 different types of credits that are taken at that individual level, and then give you links to the actual laws that all came into play, as well as links then to the PPP. So bottom line is a lot of value. Probably should have said at the beginning, this is all for $197. I mean, probably the Excel spreadsheets giving you some examples, or the flow charts might be worth it potentially just in that. All right. Hey, thanks for tuning in. I'd love it if you'd subscribe. And then don't you ever forget, you've never met a CPA quite like me. Have a great one.